Hello and welcome everyone to another episode of our value investing series. We have a very special guest with us today. So in thinking about introducing him, I have to start off with a series of experiments, a series of studies that were done at Stanford by the professor Walter Mischel in 1960s and 70s. These are also most widely known as the Stanford marshmallow experiment that you might have heard of. Essentially, it was an experiment. It was basically a bunch of studies in which children were offered a choice between one small reward provided immediately or two small rewards if they waited for a short period, which was about 15 minutes, during which the tester would leave the room and then return. The reward was sometimes a marshmallow, but often a cookie or a pretzel. In follow-up studies, what these researchers found was very surprising. These children who were able to wait longer for the preferred rewards tended to have better life outcomes as measured by SAT scores, educational attainment, body mass index, and other life measures. Now, why am I mentioning this? Our guest today is no psychology professor, but he happens to be a Stanford alum, and he happens to be a world-famous value investor. In speaking about his investing process and philosophy, you will see parallels between delayed gratification. Let me share a quote from his recent interview with all of you. He describes his process saying, "We tend to benefit in life when we sacrifice something today to gain something tomorrow. That is true for companies, that is true for individuals." His focus, he says, is on businesses that have the capacity to suffer. That is, they can reinvest their capital at high rates of return so that the wealth will continue to compound into years into the future. Thomas Russo, our guest, is a preeminent investor of our times who began his investing journey in 1982 after an encounter that changed his life. He was studying law as a business as a graduate student at Stanford when Warren Buffett came to address his investment class. As Mr. Russo explained in a recent interview, he was dazzled by the speed of Buffett's mind, his quirky delivery, and his beguiling habit of quoting everyone from Bertrand Russell to Yogi Berra, and the wisdom of his deeply thought ideas. This inspired him to finding his own investment vehicle and getting into and starting his value investing journey. We are so glad that he's here in person to share his experience and his journey and his insights with all of us here. Thank you for coming. So without any further ado, ladies and gentlemen, please join me in welcoming the one and only Thomas Russo.
Thank you, sir. Very nice. I'm so pleased to be here. I actually thought that the setting would be a much different setting. I thought we'd be underground in some catacombs with a group of people worshiping an outlawed faith in Silicon Valley, the faith of value investing. But here we are next to the free food, the wonderfully lit room, great chairs. So being a zealot in the investment business today doesn't bear the marks that it did 2,000 years ago for religious zealots, I guess. It's a great honor to be here, especially at this time. It's a really good excuse to get away from the markets, which is something that's welcome. Even though I say that, we've had an unusual period of time which reaffirms what Sarapa described as this value investing preference for businesses that have the capacity to suffer. Because if you think about my last 3 years, we've certainly suffered when compared to the S&P 500, which has been elevated by sort of global capital flows. And we've had businesses that right through this have been investing in their strong global brands, but showing modest growth at the reported level because they often invest a portion of their net profits against future business prospects. Now, recently, almost a third of our portfolios in beverages, And the world is now quite reaffirmed about the value of beverage brands through the noise about the AB InBev acquisition of SAB Miller. We own both those shares, and it's helped generate performance recently in the face of a plunging market. And then I was reminded of this again today, which was the results of an announcement by JT Tobacco to acquire American Spirit from Reynolds American Tobacco. Well, quite extraordinarily, the price was almost Silicon Valley-like. It was 300 times operating income for a business. They paid $5 billion for a business that I think had around $500 million in revenue, much smaller base of profits because it's still investing in its own growth. But they saw something that they could take around the world, and it reaffirms within a business like RJR, where people often overlook the investment because it lacks sizzle, that the strength of the brand, the predictability of cash flow, and the ability, most importantly, to reinvest that cash flow going forward leaves it quite valuable. I'm going to come over here so I can move some of these around. I did, in fact, also welcome the chance to come up because I'll talk tomorrow to the students in Professor Jack McDonald's class, which I've done for the past 25 years, having graduated from his class. And it was there that Buffett came to our class and provide some early insights. I'll go through a couple of quick slides. As an investor, you're always, at least in the value investing world, encouraged to invest for the long term and let market disruptions pass you by. Hold on. And I was reminded of this in June of 2008 when I was in Africa with my family on a safari. And every day we would go out to visit the range and look for animals. Each one looks more ferocious than the next. And every single time the guide would say, look, if you're ever separated from the group, and you're alone and you're being charged by a lion or anything else, he said, a chameleon, anything that might come at you, freeze and it'll ignore you, run right past you. But if you run, they'll chase you down. And that was the rule again and again and again. Finally, we came upon this guy, and he said, that's a Cape Buffalo. If ever you're alone and you're separated from the group and you see one coming charging at you, run like hell. And so that happened in June of 2008 when the markets were just in free fall. And at the time, I sort of felt like maybe we should run like hell. We didn't, and we haven't. It's been my belief that equities are the preferred form of investing for one capable of enduring short-term pain for long-term gain. The equities will be the best way to do that. And along that line, I would just want to make a point about this other Stanford experiment that you referred to. I do believe definitely in deferral in the investment world. As you can see, a little less as it comes to marshmallows. I tend to grab the big ones and eat them quickly. So, but the principle is the same. In fact, I incorporate the principle in one of the early lessons that Buffett gave at an annual meeting at Berkshire, where he said, really investing is as simple as Aesop's fable. It's about the bird in the hand versus the bird in the bush. The only thing you need to know is how, because you know what you have. What you need to know, which is uncertain, is what you'll end up with when. And he said it's as easy as that. And then he said it's as hard as that. I'm in an audience at Google, and I think I read that the minutes spent on YouTube in the last second quarter versus the prior year was up 60% to, and that's on 1 million users. And I can tell you that if you keep up that type of growth rate, it won't take that long. I mean, you'll know what you're going to have, which is a lot. It's going to happen soon. But in most businesses, you're not blessed with 60% growth rates. There's something much less commanding. But it is about what you'll end up with. And so I think that's a good emblem. This I take from one of our largest holdings, which is Nestle. They, like Google, talk extensively about corporate culture, because that is what you can bank on when you make an investment. We own businesses that are supposed to reproduce themselves over time, and you need a strong culture. And the head of Nestle's Japan business once showed this slide and remarked upon how lovely he thought that 700-year-old temple was. And then he said, now, none of the wood's 700 years old, but the temple is. And I thought of that as sort of an apt metaphor for what businesses are like. I mean, none of you will be at Google at some point, but Google will hopefully still be Google. The timbers are all changed out here, but it still stands for the same thing. And you'll be a very different company when you're all gone. But Google should still stand, in light of its context at that time, as a business with the same virtues and values as it is today. And that corporate culture is extraordinarily important to myself because most of the money that I oversee is invested through me by wealthy families, family offices. And for them, it helps a lot to hold the business for a very long time. And the only way you can invest based on that belief is you get the corporate culture right. I came out of the Berkshire, Warren Buffett's Business Mind class in 1982 at Stanford Business School with a couple of sets of information captured here. First, the 50-cent dollar bill. That used to be the old-fashioned way of thinking about value investing. If you could buy a 50-cent dollar bill, your margin of safety was quite great because of the discount. Your internal rate of return, however, depended exactly on when that discount closed. And if it closed in a year, you'd make 100% on your money. If it took 10 years, you'd make 7% on your money, and so on through the rule of 72. It's also problematic because it's taxable. So in that old model, if you took that 50-cent dollar and bought and realized the dollar, you pay 40% tax on that now because long-term gains have been less favored, and you have to redeploy the money into finding something else. It didn't seem like much of a thoughtful way to conduct affairs from my perspective, especially since at business school, Warren gave the class the primary benefit. He talked about the only one thing that the government gives you as an investor, which is the non-taxation of unrealized gains. They give you one other thing, which is that you can deduct losses for tax purposes, but you don't want to go there. You're much better off finding something that you can hold so that the gains that you get over time are unrealized. So when he spoke at our class, Berkshire traded at $900 a share. Today's at $200,000 a share. It's never paid a dividend. It's never done anything except compound. And it's only because he's been able to reinvest at such a high rate internally. And rather than try to close the discount, which the discount that we started with, he just let the intrinsic value compound, and the market price will track it over time. Warren also said that there aren't that many good businesses in the world. As an investor, you should select a business that you find interesting so you would follow it and you'd spend more time with it. For me, that was consumer brands. Early Buffett investing was sort of transformed once Berkshire bought See's chocolate in the early 70s. And I heard from him early into that exercise, but he already had realized that See's gave him the ability to raise prices regularly because the consumer doesn't believe that there's an adequate substitute for the brands that they embrace. I recognized that once flying on an airplane, and the person next to me ordered a Jack Daniels. The steward said, "Sorry, we just have Jim Beam," and he said, "I'll have water. I'd rather have water than the one that I don't really identify with." And that brand loyalty, by the way, is what we look for at the heart of our businesses. That gives pricing power, that gives predictability of demand. In fact, it's that brand loyalty that at some point you guys are involved with creating and sustaining through all of the work that happens at Google. But that's the sort of Uber brand value rather than the search brand value, so we can talk about that later on because I'm intrigued by Google. So what did Warren say? He said, margin of safety is required. The 50-cent dollar bill, however, changed by the time I met him because he realized that a business that can price has the ability to grow, and that growth is more powerful than discounts of inert value. So he said, observe the tax efficiency of holding. And then he said, you're probably going to have to find managers who are owner-minded if you're going to hold for a long time, because otherwise they'll steal from you. So the question is agency costs, and that's actually at the heart of the investment contract that you have with your public company managers. There is a contract that says you'll have the use of my money, my investors' money, but you have to treat it as if it's your own. You can't prefer your returns to their returns. That's very hard to find. And so in my world, where I found it to be available, is through family-controlled companies, where the family exercise dominion on their own rights over the management to do what's right for the next 10 generations of the family. That starts to feel comfortable to me because of my long-term mindedness. I like businesses that invest for the very longest term and do so with the owner in mind rather than management. The average U.S. public company, by contrast, has no family entanglements. It's purely public. There's absolutely no image of a shareholder when people think about the contract. I actually met the CFO of Coca-Cola recently, and she referred to shareholders as stakeholders. And I said, don't you really mean owners? Because the word stakeholder, I mean, you could be a stakeholder if you're the community, if you're this or you're that. There are all these concepts. But in business, what you really want your agents to think about is the owner at some level. Public companies are so far removed from that, it's not even funny. Really, it's the idea of how do you make the public company's money, management's money. The most efficient way designed to do that are stock options. And stock options have one problem, which is they only work over a specific period of time. After which, if the price isn't struck, they end up being worthless. So the one thing public companies start to spend an awful lot of time caring about, way too much, is time. They need it now. And in fact, Wall Street loves companies that are willing to present things early on because it means that they can predict more clearly what the world's going to look like than what natural outcomes ought to allow. So they can say, you know, the General Mills is going to earn $1.50 this quarter, and General Mills will earn $1.50 this quarter. They won't really earn it, but they'll report it. And they'll do that again and again and again. And then over time, by taking steps that get the outcome to meet the target, to keep the share price up, because there's no volatility, it's all predictable, they hollow out the franchise. Just the opposite of what we're looking for. We're looking for businesses that are willing to completely thrash the near term in pursuit of the long term. But in order to do that, they have to have security on one issue, which is control. That's where the family-controlled company comes into play, because they can with their super vote, defend against the pressures that normal managements are willing to assume in the complicit bargain that they have with stock option-driven compensation. I'll fast forward for a second. I pulled this from the Google founding principles. And I mean, right at the heart of what Google talks about and what I think gives you such endurance is this structure, this third paragraph down, second sentence, this structure will also make it easier for our management team to follow the long-term innovative approach emphasized earlier. They have the management's back covered, and they allow, from that standpoint, investments that have a very long payback but upfront burden to take place at full amounts. Because it's my belief that most public companies, the error is on underinvestment upfront to make sure that the results are in effect overstated. Now, I use the term capacity to suffer. It's a funny one. It was partly derived from another investor you may have met with or heard of called Jean-Marie Eviard, who runs SoGen's International Fund. He's quite an early international investor. And at a Columbia function I was at, the business school, somebody asked him what he looked for in analysts when he was hiring to build his investment team. And without a moment, he said the capacity to suffer. And I thought that was an appropriate definition. And the reason he said that is that it's so rare to find that in America. Because as a country, we always think that every single day should be better than the prior day. Right? So actually, there's a great quote in the book that I just read, Work Rules. And he talks about a guy who was in a cubicle, and he said every day of his life is worse than the day before. That's the capacity to suffer. But in the investment world, the capacity to suffer is hard to find. People expect returns to come easily, regularly, and they don't. And so his recognition was that you have to have people in the investment business constitutionally prepared to have deferred deferred results. All right, so if we start out believing that we're going to hold something for a very long time, what it needs to have is the capacity to reinvest internally. For me, I use consumer brands as the industry through which I invest because they tend to be very enduring. You think about communist China. After the veil lifted and commerce could go back in, the number one cigarette in communist China the next day was a cigarette that hadn't been in the country for 55 years of communism. It was the old British-American tobacco brand called State Express 555. Hadn't been in the market, but somehow it was still in the brains of the consumer. Same thing with Romania when the wall went down in Romania. The number one thing that the Romanians wanted were Chesterfield cigarettes. Well, you can't even find them anymore. But that brand endured for 55 years in the consumer psyche. And what we look for is the ability to reinvest behind those brands. The strength of the brands tend to allow for more regular free cash flow because of the pricing power that you get. The likelihood of finding owner-minded businesses goes up with consumer brands because they tend to have been over the life of the company more self-funding. You think about why it is that most American companies don't end up with control shareholders because if you're in a crummy business, it takes a lot of money to grow. And you have to raise additional equity again and again and again to fund the growth. And at the end, if it's a sufficiently competitive crummy business, you're going to have horrible results and no control shareholder. The presence of a business that still has control held by the family is an evidence of the fact that the business is, at its heart, quite cash generative. Now, it's not enough just to be cash generative. What you really want is to have the capacity to have that cash that the mature markets deliver in the world of consumer brands available for reinvestment globally, where 95% of the world exists in population and where GDPs are escalating and where consumer disposable income is just growing. And so we want to have brands that have relevance abroad, which gives them the capacity to reinvest mature market cash flows into growing markets. It leads this portfolio that I oversee to be primarily European. That's for a couple of reasons. One, the European managements aren't nearly so accustomed to compensation based on equity options. And so this notion of having to do something quickly and fabricate numbers to make sure that the Wall Street analysts are pleased enough to keep the stock price high enough for your options to be worth something, it doesn't exist over there. They pay people cash. The brands that exist in Europe have been abroad more historically and hence are more embedded in the culture. In India, you have Hindustan Lever. Well, that's Unilever. You have Cadbury of India. That's Cadbury Schweppes. You have Nestle of India. They've been around, in the case of those three, for at least 50 years. And their aspirational character was developed over that period of time. And that aspirational character gives pricing power. And that pricing power allows for reinvestment. So we're looking for global brands. We like the developing and emerging markets because that's where the newly formed demand is arising. That's where the markets are uninvested in. And that's where GDPs are rising. Everything I'm telling you actually was more true as a context 2 years ago than today. If you think about the stories of the current world, collapse of commodity prices, pulling back of manufacturing, China coming back. So lots of what I've built into my investment thesis is sort of in flux, and it's an interesting time. But it certainly has been for the past 25 years, the course of my investment career, a one-way tailwind. The opening up of markets leading to the transparency and liberalization of societies, leading people free to buy things that they long aspired to, leading our companies to have a place to pour back their free cash flow into meeting that consumer need as it grew. What else you need is, this also favors the international community. One thing you need to expand internationally, if that's where your growth is going to come from, you better have multilingual and multicultural managers. Multilingual surfaces quite quickly. In this audience, how many people here speak more than 3 languages? Good. It's rare. It's really rare in North America. It's not at all rare in Europe. So Nestle, I think the top 100 people in the management team speak 4 languages, and in Kraft Foods in Illinois, they speak 0.9. Multicultural, that's important. Let me ask somebody a question here. How many people, but just by raising your hand, how many people have a favorite cricket player? Well, see, you're a very unusual company. That's what makes Google great. Nowhere else, if I ask that question, will a single hand go up. 1.7 billion people go to sleep each night thinking about their favorite cricket player. And if you're going to be effective internationally, you probably want to have somebody who understands that storyline. So the capacity to reinvest is not democratically shared. I made light of Kraft. Indeed, we had and sold all of our stake in Kraft because of their provincial portfolio and their lack of natural reinvestment. They tried to go into China. They failed. They came out. They had no people to develop the market. They didn't understand it. It's a domestic company. And it's a company that's made lots of money selling cheese and cookies and meat to Americans. And America was a big enough market that it kept their ambitions fully staffed, but they had no capacity to go internationally. We want businesses that can. Nestle, Unilever, they have the bench strength, they have the brands, they have the cash flow, they have the understanding of where the puck's going. Now, in order to do it the right way, you have to have the capacity to suffer. That means that when you open up a new market, you're going to have unabsorbed fixed costs in spades, and that will burden current income. If you're not protected through major shareholders who support that long-term vision, I can assure you today, especially so, you will have any number of a dozen different activists come in, buy 1 or 2% of your company, and demand better. You can do better. If not, we'll kick you out. And no management team wants to do that, especially midway through an investment cycle. I'll give you a quick example. We owned shares of Cadbury Schweppes. It was a terrific business. They had 3 pillars. They had gum, chocolate, and hard candy. Each one of those came from a different background. Each one was dominant in different parts of the world. Put it all together. They had great market presence in parts of the world that had been massively underserved. The joy of eating sweet things. So what do? They decide that they try to launch the business in China. And they start out in Hong Kong, Beijing, and Shanghai, and they knock the ball out of the court. Everyone believes it's a good business. The Chinese line up. They like it. They go to 200 of the next cities in line. So that takes you down to cities of 1 million or more, but there are 200 of them. Now the suffering really starts. Now they're spending a lot of money. They have to introduce the brand, they have to build awareness and all the rest, and they do it across 200 cities. Now, I heard from the CEO of the company, sort of midstream through this, he understood that the investment spending was going to just overwhelm the reported profits out of Hong Kong, Shanghai, and Singapore, and Beijing. In fact, they'd show losses for as long as they could see. And every year that went by and they invested like this, they built net worth. Because they converted consumers who became loyalists and who had lifetime consumer pattern. And you can know the upfront value of a converted customer addicted to sweet things. They were midway through the process, losing a lot of money. Along comes Nelson Peltz, knocks on the door and says, you got to do better. The numbers just aren't advancing. We think you have to do something. Give us some earnings. So the board and the CEO went home over the weekend, came back and said, right, we think we have China wrong. That investment work we're doing in those 200 cities, we're way out in front of our skis. It's just not working. Let's close it. Now, with that, they manufactured income because they stopped bearing the costs of investing for the future. They destroyed wealth because all the people who had bought on board the brands now no longer could source them, and away went the equity, the goodwill that they had created through that investment spending midstream. And they lacked the capacity to suffer because when a raider came and rattled their cage, they said, fine, we'll do just what you need. We have a handful of examples here, which I'll go through quite quickly. I'd say the best example of a company, two, that have the capacity to suffer. One is inside this room. You think about all the kind of projects that Google incubates, burdening profit, with an idea maybe of where it'll end up, but in some cases not even. That's extraordinarily powerful. And you have lots to show as a result of that. That scale would be a very interesting one because I think you have an awful lot to show for the willingness to suffer. And Amazon's way out even beyond you guys. I'm not sure that they'll ever report a profit, but they certainly have the capacity to suffer. So do their shareholders. Well, of course, they get rewarded for it, so the price has gone up so much. The business we'll look at are more traditional. Berkshire's the best one. That's where I learned this subject. Warren talks about it all the time. But Geico's a great example. Much like confectionery in China, it's expensive, it turns out, to bring on an insured, auto-insured. And so when Warren bought Geico, control of Geico, he asked the CEO why they only had 2 million policyholders. And the CEO said, because it's too expensive to grow. Every new policy we put on the book loses $250 in the first year. And they're making ongoing insured make $150 per year of operating profit for the company. So you have 2 million policyholders making $150 a year. So they were reporting $300 million of profits. And if they wanted to grow 1 million new policies the next year, because as Warren said, they had the best business, underpenetrated. The market should have more of them. So why not grow it by 1 million policyholders? What would happen to the operating income that year? It would go from 300 to 50, assuming that the other business didn't grow at all. Now, no public company can endure that kind of volatility. The activists would be on that thing so quickly. Inside Berkshire, it didn't matter. Because Warren controls 40% plus of the stock. He's never told investors that he's in the business of manufacturing reported earnings. No one gets stock options. He gets paid $100,000 a year. It's all about owners' equity, intrinsic value, and how do you grow that with certainty as best you can. Well, no better reinvestment than to take that 2 million insured base up because of its persistency and its low claims, lack of adverse selection as they grew. They had a lot of room. Now, and by the way, even though the first year reported loss of a new insurer was $250 up front, the moment they signed up, the net present value, lifetime value of each insured, $2,000. That's $150 stretched out forever, brought back. For the mere inconvenience of reporting $250 loss up front, they put on $2,000 of value. Warren got it. Today, 14 years later, they have 11 million policyholders. And in the annual report, he said to investors, because he's a fair partner, if you're thinking about selling the business, your shares in Berkshire, understand that book value doesn't capture all that we've got that's good. And he said, for instance, at Geico, we've added $20 billion of value since we bought it. Now that's that $20 billion that comes from those 9,000 new insured. And the only way you get there is by having the capacity to let the income statement bear the burden. And over that time, they took their annual ad spending from $30 million up to $1 billion. And you'd all know that because watching television is really a series of Geico advertisements these days. Another thing that Berkshire did, was the equity index put options. There's a group that had $37 billion worth of equities, market value equities around the world, 4 different markets. And whatever the reason, that group had to be able to say to their counterparties, that $37 billion was not at risk. They needed for their collateral, whatever the reasons, to have $37 billion. And so Warren was asked to insure against the potential for that portfolio to decline in value. He sold them a put option. In return, we received $5.3 billion to invest unfettered for 18 years. It was non-callable, and it had no collateral posting requirements, which are the killers in this business. So why did Warren get $5 billion to insure against the decline of equities over 18 years when likely course of equity values is up over time? And it's because the people who needed that insurance had nowhere else to go. First, Warren had the capital. He had $50 billion of spare cash, which sort of buttressed his claims-paying appeal. Other people who might take the $5 billion don't have the capital balance sheet or the culture to provide for the ultimate payment if the world went to zero and they owed $37 billion. Warren has that, and the culture would honor that. The other thing, the more important thing, is nobody else would touch this stuff because every quarter there is a mark-to-market requirement. And it absolutely crushes reported profits. So, for example, after they signed it, received the $5 billion, the equity world markets collapsed, and they had 6 quarters in a row of over $1 billion worth of charges to the income statement, some periods as much as $3 billion, because global equities collapsed. And every time it collapsed, they'd have to pass through the reported profits, the mark-to-market. Okay. So at the end of the day, he had $13 billion less in earnings cumulatively over that time. But he had $5 billion which he put to work. And that's sort of the last story about Berkshire. Is another way in which you could see his capacity to suffer added enormous value was that during the crisis, during the period leading up to the financial crisis of 2007 and 2008, Warren at the annual meetings always lamented the fact that he had $50 billion in cash hanging around. Well, and on which he was only earning 0.1%. So, and that's the safe return. That's sort of the federal treasury bills that are secure. Since he kept it in cash, you might as well keep it secure. But he's only making 0.1. If he had standard company practices, he never would have kept $50 billion of cash in overnight money. He would have gone out 3, 10, 14, 40 years on a bond portfolio and would have had a 4% yield. He kept it at 0.1 because he didn't trust inflation or credits to support having $50 billion in longer duration investments. The difference between 4% and 0.1% on $50 billion is $2 billion a year. That's the amount he suffered by underreporting because he kept his money in liquid treasuries. That requires a lot of suffering because $2 billion is a lot of money even to Warren. Now, ironically, to show you how American companies behave, at the same time that Warren was bellyaching about only making 0.1%, General Electric had taken $100 billion of their borrowing and brought it into commercial paper overnight to capture those same low rates. Now, it's a different story if you're General Electric, though. You have businesses that have long-term funding requirements where you can't responsibly borrow overnight to meet. You can do so if your goal is to manufacture earnings. And off $100 billion in the overnight market where they might be earning 2%, they may be paying 0.2%, let's say, maybe even 0.3% in the commercial paper market. They should have been paying 4%. Exactly like Warren. They should, in their case, they should have stretched out their liability structure. But by taking it all into commercial paper, investment bankers assured them that they could swap them out at any minute. They could go back long. They could go into yen, any currency they wanted. It was just a number after all, wasn't it? Well, they forgot one thing, which is that overnight markets can shut down. And when Lehman burst, GE had $100 billion of overnight money that they couldn't roll. Warren happily had $50 billion, which he could use to help them out. and he gave them the right to $12 billion of his money at 12% with hundreds of millions of shares of call options. In case the company did well, he would have the privilege of making the equity that they recklessly threatened by their non-owner-minded ways. Now, they were not at all unusual in this. This is what public companies do. They bring down the risk, the cost, because it helps flatter. In the GE's case, that was $4 billion of manufactured income. Now, mind this I would complain to you about. However, there's one mega force on the landscape that's done one worse than that, which is the United States government. We have taken our borrowings from 9 trillion to 18 trillion through QE, most of which was not invested but was transferred to try to stimulate some kind of economic growth in the absence of a Congress that doesn't meet. And we keep that money predominantly in overnight borrowings. The yield curve of the U.S. Treasury is abysmally short term, and we are massively understating when we look at our own deficit what this country has put itself into, which is $9 trillion of additional borrowing coming through at sort of 1.5%. And the real cost of that burden will be very apparent at some point when rates go uncontrollably by us upwards beyond our control. Anyways, I hope that what for me has been most educational from the time I first heard Warren speak at Stanford to the present, this notion of how the capacity to reinvest surfaces is best to illustrate, I think, by those three ideas in Berkshire, and there have been a whole series of businesses they've done afterwards. Nestle is extremely well positioned in the landscape of what I look at by virtue of having all these billion-dollar brands widely distributed throughout the emerging markets, aspirational and available increasingly due to the hard work of multilingual, multicultural, people delivering their business. The company does not hurry. When I first invested in the business's shares in 1987, the CEO then, because of Wall Street's miserable reaction to their patience, said, well, what is Nestle's planning horizon? And this is the CEO. And he said, without a flinch, he said, our planning horizon is 35 years, but we tend to break it up in 5-year increments. Now, this is what you want of a company if you're thinking long term. I think American companies have a 35-minute, not year, planning horizon. This graph, I think, just demonstrates what it is that we're about, what we're going for, which is on the far left, as you look at low per capita GDP, and you move up to the right, you go from subsistence to buying better to buying luxury. And there are 2 or 3 billion people in the world sort of at the far left of 2,700. I mean, I think in China now today it's 7,000 of GDP, but it's bifurcated badly. Probably 500 million have less than 1,000. In India, there's 500 million less than 1,000 in the rural areas. The country's probably much higher. But it's that migration from, subsistence with no commerce to commerce and to brands that we're in the midst of, and that's what we invest behind. The company has the patience on reinvestment. If you look at the very top of this little chart, you'll see Nespresso. Very, very top. It's a business that they pioneered about 20 years ago. It took them 15 years, maybe it's 25 years ago now. It took them 15 years before they broke even on that business. They lost nothing but money for the development phase. And they built it right, and they tested it. And along the way, when other competitors had wind of what they were doing, they came out with products that were not nearly so competitive, like Tassimo by Kraft and some others who were more interested in short term. Nespresso built their business to last, and today they do $5 billion of business. Now, it's not an unblemished record because Keurig's a huge business. They should have shut them down. And Starbucks has grown to be an enormous presence in the coffee business, and they probably should have been more adept at that, but they still nonetheless had the capacity to deliver a truly great business in Nespresso, which is what these boutiques look like. Let's think here. We could go on. I'll just give you a quick overview. Pernod Ricard, great portfolio of spirits, two in particular, Martell and Chivas. They acquired through Seagram's. When they bought it, it was in the year 2000. China was going through a downturn. There was a company called LVMH and Diageo who owned they own Johnny Walker, and they own Hennessy. And those were the two largest brands in China from the West. At the time, there were about 2 million cases. At that time, Diageo said, okay, China's going into a funk. We'll just pull out because we want to protect our income, our reported profits. Why spend the money now when the market's turned down? We're probably not going to get a lot of yield from that. Let's take our brands home, maybe come back later on. At that time, Pernod Ricard had just acquired Seagram's, and with it came Chivas, like Johnny Walker, Martell, like Hennessy. And they said, well, you know what? We're a family. We own the business. No one can take us out. We don't have to worry about reported income. Why don't we go and see what we can do? Now, since then, obviously China's recovered. Chivas and Martell succeed. They're now the largest spirits, Western imported spirits in China. Diageo struggles to get relisted in the country that they once commanded but left. And they left for the wrong reason, which was maintain that earnings per share, because why not suffer if you don't have to? Well, they should have stayed. The long-term prospects of this business, however, are not yet scratched. The white space looking forward in their portfolio, in China, there are 500 million cases of baijiu, local spirits consumed a year. All of the premium Western businesses in total do only 4 million cases. So we've got 549 million cases that we can go after. And an adjutant to this will be the great growth in the Chinese tourists. There'll be over 100 million tourists this year from China. As they go to Europe, they observe. They're already minded towards those Western trademarks, and they'll come home with a couple of bottles through duty-free and start to sort of serve as local ambassadors for the brands. I think less than 1% penetration over time will be a very attractive platform from which we will grow these businesses. In India, if it weren't the case that the government has such barriers to trade, we could see that business even bigger. I would ask the question of anybody here who travels duty-free into or from India, what 2 bottles of spirits does every Indian buy when they return home? Yes. Oh, you're very high-end. Oh, you're high-end. No, it's Johnny Walker Black Label. The numbers, Black Label is the big one. But the Chinese, the Indians consume 125 million cases of what looks like Scotch, locally made. Imports are very thin, and Pernod Ricard controls the market along with Vijay Mallya. But when and if, I guess I'd say because of what Modi said yesterday at the SAP Center, when, not if, free trade descends, we will sell so much Scotch whiskey, authentic whiskey, into a market that prefers it over the local brands, that the investments in Diageo and Pernod Ricard will just, I think, be pulled along. In the meantime, they're suffering. They're not covering, they're not absorbing the costs because it's expensive to maintain market presence and only sell at the very highest end because of trade barriers. Anyways, Pernod, I think, it stands where it does because again and again and again, like in 2000 with China, the family has the ability to outcompete standard public companies who worry about stock options and quarterly numbers because they are free to think long term. And if you sat there and watched a public company dismember their premium status in China, and you said, but for quarterly earnings, they would have stayed, and you go into that void, it's a terribly attractive structural advantage that I think we pick up by sticking with these businesses. S.A.B. Miller, I like this slide. It's now, unfortunately, in the midst of being taken over, which is a disappointment because they had the right mindset. They were South African breweries. They were a pariah company. They started with nothing, and today they are the second largest brewer in the world. Maybe the largest because of the Chinese operation. When they invest to develop the future, however, look what happens to the EBITDA margin. Revenues went up a lot over this period of time. This is some time back now. Revenues went up a lot as they were pouring money into developing the markets throughout Africa that they had a toehold in, but recognized at some point that they were underinvesting. They stepped up the investment massively, grew revenue, grew volumes, EBITDA margin plunges. That's good. That's the burden on reported profits that came from the upfront development costs of opening up those markets. They had the ability to absorb that because of the control shareholder group. And Brown-Forman is the last one I'll talk about. It's ironic. This is how screwed up America is. In Brown-Forman's case, what I call the virtue of family control, which is the alignment of interest for the long term, which means that they're often traded more cheaply in the marketplace because people worry about corrupt families. But the irony is that instead of celebrating family control in their proxy statement, they have to have a section that says, a risk factor is a substantial majority of our voting stock is controlled by members of the Brown family, and collectively they have the ability to control the outcome of shareholder votes, including this and that. We believe that having a long-term focus, committed, and engaged shareholder base provides us with an important strategic advantage, so on and so forth. However, they flag it as a risk factor. I celebrate it as really one of the great things. And I first invested in their company in 1987. They had made a bunch of investment banking-driven acquisitions, all of which flopped. And at that point, they committed as a family to do nothing but grow Jack internationally. Wall Street despised the shares. They had sharply declined when I made the investment. The company had committed at that point on to take what their heritage was and invest against the future, spending internationally. At that time, as this, let me go, oh, I'm going the wrong way. At that time, as this shows here, international markets were only 500,000 cases. This is when I bought the shares. Domestic was 3.5, and they committed to growing that business abroad. Now, that meant nothing but years of burden on the income statement. Fast forward to today, they have almost 10 million cases internationally. The U.S. business came back because bourbon, for reasons nobody knows, became popular. And so it grew. But the international one is the deliberate result of investment spending. If you look down below, in 1987, they had 5 markets that had over 50,000 cases, 4 with over 100. Today, they have 41 markets with over 50. The march towards 50 is very unprofitable. You have all the fixed costs of a distribution, network, partnering, advertising, promotion. You're not making a lot of money. Over 50, you start to make a lot of money. I think the next 10 million cases will be much easier to get than the past 10 million cases. During this time, let me just take a look back here. The business that I first invested in, if you look down this list, had gross profit of $563 million. Today they have $2 billion. Operating income of 182, it says 971 million. They dedicated themselves to doing nothing but growing their business, and they had the voting control by the family that allowed them to do it unflinchingly. When they had leftover cash, they took it to buy back their shares, 360 down to 215, and their the EBITDA went from 200 to $1 billion, and their share price went from $3.76 to today it's 110. And it's been about a 13% compound, which is sort of what you can really aspire to in public equities, in companies that don't have the kind of profile that Google enjoys. But this is a hand very well played. Family had a business that had integrity. They had a culture that's extraordinarily focused on making sure that nothing that they do dishonors Jack Daniel's, the heritage. And they're willing to tell that story broadly at the cost of current income to deliver long-term wealth to the family. And so I show it because it worked. We have plenty that haven't worked, just by the way, where the spending didn't sort of yield results. But one of the things you have to understand is that I think businesses have to have that capacity to suffer. And it's true to say that investment managers have to have the same capacity. And so if you look at the history of my portfolio returns, you'll see in 1999, we were down 2%. The Dow was up 27, the S&P was up 21. In the following 3 months, I think that both of those indices were yet again up higher, and I think I was down up as 10% down the first half of 2000. And the NASDAQ was up another 50%. I had to have the capacity for my investors to allow me the right to underperform by 29 percentage points. If I was going to deliver the kind of returns that we have long term. And if you look, as a result of being enabled to be out of step for that period of time, we ended up adding the most value ever in the subsequent 3 years by not having the same declines that consumed what looked like those early internet vapor returns that influenced the market. But I need to have the capacity to be totally out of step with the market if we're going to add value long term. And that year is a good example. Now this year, I think I'm down 1% at the top, and I think the Dow and the S&P are both down 8%. So the markets have become quite volatile. This is the portfolio. The names should be kind of familiar: Berkshire, Nestle, MasterCard, brilliant company, Philip Morris. Most of them are international. Most of them are family controlled. And I think on that note, I'll just ask for questions.
I had several questions. Maybe I'll give everyone a chance and come back.
Let me take my tie off and settle in. Fire away.
All easy questions. One thing that stands out in your portfolio is MasterCard.
Yeah.
It's unlike the other holdings you have. It's a strong consumer brand, not a family-controlled business, very asset-light. I think if I look at the financials, most of the cash flow converts into free cash flow, not that many opportunities to reinvest, but a long runway. So kind of being different from all the other holdings, would you maybe share your thoughts on how you think about it and the factors like disruption in the long run, things like that affect MasterCard more than other things?
Yeah, it's a great question. It's a big holding. It's really aligned to capture exactly the same forces that I'm looking at in the consumer portfolio, which is the rise of commerce globally. And understand that at the moment, 85% of global commerce is still cash. Okay. And MasterCard's set about to convert that. And they have some partners in this process, and they have the capacity to suffer along the way. Not because it's family controlled, you're right. But they somehow have gathered a group of investors, including us, who have been willing to grant them the right not to have operating leverage flatter their statements. So what happened is when we first invested, the world collapsed. The shares plunged in 2010 because of trouble in domestic debit. MasterCard's all about global credit. But the domestic debit business changed after the Durbin Act, Dodd-Frank, and the shares sold down to a modest level. I met the management team, and the business is fine. And they're highly exposed to the growing and developing markets, which I like. It wasn't until Ajay Banga became CEO that I bought my first share. Having known him at Citibank, he's illustrious globalist and has the best Rolodex in the world. And since he has to implement this business through other partners generally around the world, he's a perfect person for the business. He also had a capacity to understand that his job was to deliver to his successor a much stronger company. That's his view. And so every year since he's been at the helm, the gross dollar volume of business passed through their business has grown about 13% a year. It's a very high fixed cost business. So all that advance suggests a higher margin. You don't see it. He's taking that incremental operating income that arises from more volume over a fixed base and reinvesting it regularly back into programs. He has 55 projects that he started since he was there. He hires, against your great demand, PhDs and millennials, and he's changed the orientation of the company. And so they've poured back into the business investments against the income statement that keeps the income statement low, lower than it would be if they just let those advances. Now, the trick is they have partners in this business. They have partners in the form of governments. And in Africa, for example, the government wants payment systems because they want to be able to disperse social benefits to the intended beneficiaries without exposing them to the horrors of check cashing locations, which are surrounded by casinos and bordellos and people who are trying to steal their money. Instead, they drop the money into biometrically activated cards or phones as payment devices. It's very efficient and gets rid of all the friction. It's 25% to cash a check and all that stuff. It's gone. Other countries want to implement payment systems because they want to enhance tax collection. The Koreans understand that their people will not declare taxes honestly, and so 93% of commerce in Korea by mandate is being done through payment systems, not cash. They just don't trust their citizens. And the way you get around that is you have a taxable audit that's part of the MasterCard record. And so we have all sorts of products that are high technology payment systems using all sorts of phones and other devices. And there's just a general movement. And since I'm oriented with the belief that global commerce will grow, we have 85% of that is in cash. We're going to convert a higher base over time. So it's expensive. It's gone up from $20 a share to $90 since I bought it in 2010. So at $90, it's not as compellingly undervalued, but I still think they have so much work ahead of them that it's a worthy hold.
One follow-up thought, is the capacity to suffer evident in the fact that MasterCard has significantly lower margins, although very nice margins, than Visa's?
But that's because they're investing so much.
So do you think that's why Visa
That's
is
the
higher?
measure, yeah.
So Visa is, maybe the indication is Visa is not investing as much. Okay.
Yeah, I mean, they have their own problems. They have to buy Europe. They don't even have a full global map yet. And so they can't invest with certainty like MasterCard can, because they know that if MasterCard comes up with something, they can go around the globe just like that. They have to stop at the European gate and say, can you do this? And they'll say, no, yes, maybe. So it's just not as harmonious. And I do think that MasterCard is way outspending. The history, at least. Now, Visa has a new CEO, and they're probably altogether much better at their game, but that historically could explain the difference. And I like that I think competitive position that you see with that lower margin, because they're investing more.
Thank you. A wonderful presentation.
Thank you.
Thanks a lot. I had a question about controlling the companies. You said there's a family-controlled factor that comes into play, and that helps in basically investing in for long term.
Yeah.
Do you feel it's exactly the same kind of control that comes in with a tiered share class, where there are some classes that have a higher vote and some classes that
it's the same. It's blocking. I mean, it's the thing that allows you to say to someone who would like to come along and ask you to change your orientation, where the answer is no, we like it, and you can't make us. And however that's sourced. Now, there's a lot of hand-wringing over the fact that super voting shares mean that you control without having the economic interest aligned. This is a company that set itself up that way. It's a young new company, and that was the terms under which they embarked. And I think it's healthy to have that kind of stability. We'll see with time, but I think it means that you guys can all, you people, can all do exactly what it is that most inspires you, and do so without regard to the possible hot breath of an activist. Because I mean, think about how Yahoo is all congested by virtue of people coming in, insisting they do this and this and that, you really can't run a business in that context, and you have the right to be free from that, and it should allow you to surface things more competitively. Yes.
I was curious to hear if you think that there's a place for value investing in technology companies, because just sort of like the nature of the industry is so dynamic.
Yeah.
Like, I'm not sure if you're familiar with Clayton Christensen's book, The Innovator's Dilemma. But
Yeah.
a lot of the sort of like in the cycle of maturity of tech companies, like they get to a point where they're almost like incumbents defending market share.
Yeah. Yeah.
And sort of investing in financially
Yeah.
viable investments, which I
Yeah.
guess in the technology industry sometimes are not those which ultimately capture the market in the long run.
Yeah.
So I know like traditionally value investing is reserved for more mature, predictable, slower moving types of industries. So I was just curious to hear your thoughts on that, like whether the strength of a brand like Google or Uber or something like that could help those companies persist despite the dynamism.
Yeah, I think it's a great question. I remember Clayton Christensen. It actually unleashed the sort of excess of 1999. Going back to that time, his book was basically a battle cry for companies to be willing to destroy themselves to succeed, right? I mean, that was the whole idea. And the beautiful image of it was that you had CEO to CEO businesses where the old technology and everything that ran the business made sense, CEO to CEO, and down to the very bottom of R&D, both the customer and the technology company recognized that the old ways were horrible, but they could never get above, they could never implement it because the top, who had to approve stuff, was quite comfortable with the way that things were, and there'll be an outside enterprise that would then engage what they already knew in-house, because it was impossible to champion an in-house solution against the kind of static top that the disruptions typically then happened elsewhere, but they didn't have to. Our research level, even in those mature businesses, the awareness was there. It just couldn't get up, and that's a culture. And so, ultimately, you've got to have a culture that's willing to, as it seems this one is, to source ideas broadly and don't do so sort of command control from the top. That at least gives you a shot, I think, at it, because otherwise the technology is so fast moving, you'll end up quickly obsoleted. Unless you've got that culture, this place may seem to have that, in which case you've got the willingness to destroy what you relied upon and move into other things.
You mentioned a lot in your discussion about sort of investing in companies that have demonstrated the capacity to invest for the long haul and to suffer and to really like make investments where it hurts. But the question that I come up with, especially regarding, say, your Geico example, is how do you distinguish companies that are actually willing to make hard investments that are going to pay off versus ones that are just chasing after things that are actually just short-termism?
It's so interesting a question. In fact, I have a slide that I rushed by, and it says, capacity to suffer is not enough. And then I had Barnes & Noble. And I had the Nook. And you think, what? Now, Barnes & Noble is controlled by Riggio. So he had control, so he could do it. But why would you ever want to go after you and Apple on a laptop or a tablet or a book reader? I mean, what possible stupidity was that? Now, mind you, along the way, they had $1 billion from Microsoft and $600 million from Pearson, so it wasn't their money. But wow, so it's got to be right. And that's the trick. That's the only thing that determines our returns over time. Is, for instance, I had a huge position in newspapers going into 2000 because I often think about a measure of whether I want to invest in a business is how many dynastic fortunes do you realize have been made from this business? Well, there was no more dynastic source of fortune than the newspaper business historically. Every city, the most prominent people in the city owned the newspaper. They controlled politics and money and everything else. And they had been able to survive each generation of technology by incorporating from print to radio to TV, TV to cable, cable to something else, and then along comes the internet, and they say, no, we don't want to share our playground with you. And it was the most unbelievable, stupid moment in the history of capitalism, because they had learned over the years that to survive, they had to change. They had to do exactly what Clayton Christensen said. They had to be willing to kind of go into these new technologies that threaten their exclusive print revenue stream for radio and then for TV. That was very Christensen-like. And along comes, eBay and Amazon, and they say no, because they were both, designed originally to incorporate a newspaper platform. No, and that cost them, dearly, because the air went out of that balloon real fast. And so, it's not enough. It's not even necessary. I just find it to be a place where we have had some success, sort of thinking through what it is that we want when we embark upon investing in businesses that we're supposed to hold for a really long time. I think these ingredients help keep me focused on important and knowable factors.
With that, thank you so much for a great presentation and wonderful conversations with us. Thank you.
Pleasure.